Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again, US Election Edition for today's Daily Dose of Market Insights. Very good morning to all. Today will be Wednesday, the 30th of October 2024. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's kickstart with what has taken shape yesterday in terms of key news flow event and as well as economic data release and their impact on the various broad-based cross-asset classes. So what we could see, let's start with the major US stock indices performance first. So very interestingly, yesterday we do see two-way movement on the major US stock indices, and this two-way movement is moving in the opposite direction. We do see mega cap technology stocks outperforming that give a fillip or a lift up in terms of the heavily weighted mega cap US major stock indices, which is the Nasdaq 100, which is up close to 1% by the close of yesterday's US session, and as well as in some form, the SPX also gained slightly by 0.16% due to their much more heavily weighted average that is more skewed towards the mega cap technology stock, but to a lesser extent as compared to the Nasdaq 100, whereas the industrial and the healthcare stocks that actually underperformed yesterday that led to the underperformance of the Dow Jones Industrial Average, which is down by negative 0.36%, followed by the Russell 2000 that is down negative 0.27%. And very clearly, this two-way of opposite movement can be seen on the heat map of the S&P 500, where we start to see only the mega cap stocks that is actually outperforming, which is the technology and the communication service sector, and one of the consumer cyclical sector, which is Amazon. So basically, it's the 7 key mega cap stocks that is actually just lifting the S&P 500 performance yesterday. Because overall, what we could see is there are more reds than green. And if you look at the grouping of the sectorial 11 sectorial performance, very clearly it's only 2 sectors that are actually outperforming, which the mega cap and technology has inside these 2 sectors, which is the communication services and the technology, both outperformed by 1.4% to 1.07%, whereas the other the other 9 sectors close in the red. So I would say that yesterday's intraday performance on the major US stock market is not that great because market breadth is relatively weak. It's only being kind of supported by the mega cap technology stocks that actually managed to hold on to the fort due to the upcoming earnings announcement of 5 of them that is due this week. And yesterday, Alphabet, Google kickstart their earnings release. So their earnings release was rather rosy. Earnings managed to beat expectation. So okay, it's not showing. I'm not sure why. All right, give me a minute. Let it refresh again. So net overall, he has 2 things: earnings beat due to a cost reduction as well, and as well as there's an increase of okay, oh gosh, what's going on? Okay, there's an increase of cloud customer in terms of the cloud business of Google, which i.e. Alphabet, and also has reduced the cost of AI. All right, in their AI research base. So net overall, what we could see over here is that because Alphabet announced their earnings after the close of the US session. So what we could see over here is that the share price actually jumped by additional 5%, if not. Okay, give me a minute. Let me highlight to you Alphabet share price. Okay. So Alphabet share price actually rose by I think additional 5% to 7% after the close of the yesterday's US session. Okay, just give me a couple of seconds. I'm not sure why is it very slow over here, my internet connection right now. Yep, Yes, so it jumped by additional 5.89% or 6% or so, as you could look at my screen over here. All right, but however, market participants has really kind of priced in because they actually push ahead by increasing 1.66% in the normal US session. So later we'll see how the price action react at 9:30 p.m. Singapore time today. All right. Very interesting to see whether this after hours movement of price action managed to get discounted at the start of the US session. Okay, so it's up by 5.89%. So what's interesting over here is that on another smallest mega, not really a very big mega cap stock, but it kind of related to the AI related optimism team play that more or less has been within this ecosystem of the mega cap technology stocks revenue driver. So even though Alphabet is not producing the AI chip, but their business is all kind of surrounding this AI ecosystem. So AMD is one of the, we call it, producing the we call it the weaponry for this AI optimism business model kind of business. Doesn't actually fare that well when they release their earnings results after the close of yesterday US session. So AMD is more of a smaller player versus Nvidia, but they are also part of this AI ecosystem that has been fueling the bulk of the Nasdaq 100 gains, and also significantly influencing the performance of the US stock market indirectly as well in the last 2 years. So what I could see over here is that the earnings guardians was not that great, and what happened is that the share price actually tumbled by, I think, 7%. Okay, it fell more than 7% in late trading on Tuesday. That means after the after hours session. All right, it fell by 7%. So very interesting to see these two conflicting news flow that is potentially having a impact on the US stock market later at the start of the normal trading session at 9:30 p.m. Okay, so very interesting to see how this price action react thereafter. So later I'll share with you on the short-term intraday technical outlook on the so-called the Nasdaq 100 versus the Dow Jones Industrial Average. So then going forward, then we have some macro data to actually share with you all, which was more pertaining to the US economy. So yesterday we do see a conference board confidence index that came up over here. Okay, give me a minute. Just yeah, this is the one. So the consumer confidence index by conference board actually rose better than expected. So it came in at 108.7 versus 99.5 that was being printed in terms of consensus estimate, and also above 99.2 that was seen last month in the month of September. So with consumer confidence that is still rather firm over here, it seems to us that compared towards the rest of the world, the US economy is in much better shape as compared to Eurozone versus China and versus some of the other major economy like in UK. So, but that also doesn't derail this ongoing expectation that the Fed is still on the path of an interest rate cut cycle, but not so aggressively as being priced earlier about a month ago. So how do we find this scenario taking shape in terms of the pricing of the interest rate cut cycle by the US Federal Reserve is by looking at the CME Fed Watch tool. So for those who are joining us for the very first time, CME Fed Watch tool enable us to give us a sense of the probability of the Fed, either they will cut, hold, or increase in the upcoming FOMC meeting. So basically, you just go to CME Fed Watch 2, Google it, you're able to get this particular interesting information. It's not live, but it's slightly 1 to 2 hours delay. Pricing data is actually based on the calculation of the 30-day Fed funds futures market. We know that the fact, futures market, they do have a series of ongoing contract on a monthly basis. So every time the CME Fed Watch 2 will take into account of market participant transaction on this CME 30 days Fed funds futures contract, and from there they're able to calculate the expectation that's being priced by market participants in this Fed funds futures contract. So if you look at the next meeting, will be the 7th of November. Currently, the current Fed funds rate is at 4.75% to 5%. So market is now almost pricing in 100% chance it will be at 4.5% to 4.75%, 4.5% to 4.75% by the time it comes to the 7th of November meeting, based on the latest data that they obtained from the 30-day Fed funds futures. That means market participant is almost sure that the Fed, it's very high likely will cut 25 basis point based on the Fed funds futures contract. This one to stress, because it's not based on survey, it's not based on any other instrument, it's just purely based on the pricing of the 30-day Fed funds futures contract. So if you were to look at this is 7th November, right? If you want to stretch it all the way down until next year, 10th of December, we can just go on to this particular, on the left side, there's one called aggregated calculation. You just click on it, it will give us the aggregated probability all the way down to a year later at 10th of October, 12th of October. So bear in mind, these dates here I can't change. It's based on American calendar date. So the first decimal point, the first 11 is actually the day, not the month. So the middle one is the month. So you got sorry, the first one is the month. The middle one is the date. All right, so this will be 7th of November. All right, over here. So at 7th of November, we know that it's almost 100% that it will bring it down to 4.5%. Then thereafter, on the 18th of December FOMC meeting, there will be another potential 25 basis point cut, which is rather high because it's pricing in at 76% chance, more than 60%, to bring it down much lower to 4.25% to 4.5%. So what market participants in the Fed funds futures contract right now is anticipating high chance of a total of 50 basis point cut before 2024 ends by the Fed. All right, and then thereafter we see a series of 25 basis point cut, but there will be a pause in between the meeting. All right, so what you could see over here is that what it means that over here on the 29th of January next year, there will be a slightly higher chance that the Fed will pause, then to cut by another 25 basis point, which is only a 44% chance. Then thereafter, the next cut will come in on the March meeting, 19th of March meeting, because there's a high chance of 79.5% chance that it will bring it down another 25 basis point lower to 4% to 4.25%. Then what we could see over here is that overall, there is actually only a series of 25 basis point cut. The jumbo cut of 50 basis point has been totally been eradicated because of a stronger data, that point that we see so far that is coming out from the US economy. So what we could see over here is that the Fed will stop cutting by the time it hit July, 30th of July. Why? Because on 30th of July, 60% chance it will bring it down to 3.5% to 3.75%. Then thereafter, we see it pausing throughout in the next three meetings in next year, in September, October, and December. So net overall, what we start to see is that market is now looking at a rather shallow interest rate cut cycle. All right, so that also supports the firmer dollar strength that was seen in the last 3 weeks or so. Later we touch more about the intermarket dynamics on the US dollar, the 10-year treasury yield, and the upcoming US presidential election situation. All right, and another data point I want to share with you all for today, just released early in the morning, will be the Australia CPI data. All right, so the Australia CPI data came in weaker than expected. So on the monthly basis, right, for the month of September, it dropped to 2.1%, right, for the September, way below expectation of 2.4%, and also way below 2.7% that was printed in the month of August. So if you look at the monthly CPI trend in Australia, it continued to tumble, and the one that is later so far at 2.1% is actually the lowest reading since July 2021. So you look at the 5-year trend, very clearly Australia inflationary trend has been decelerating as well. So that also explained to us the current Aussie dollar weakness against the dollar, against the US dollar. So very likely RBA among the developed nations central bank, they have been the most hawkish so far. So far, they have not even cut interest rate at all, and they may also during some points of the meeting, some officials even pointed out the discussion of possibility of another hike in Australia. But given this latest inflationary trend that we see in Australia so far, very hard for those hawkish voices in RBA to be very pronounced going forward. All right, so that actually also support the Aussie weakness that we see so far. And if you were to look at from a quarterly basis, that's much more lagging. Very similar scenario as well. So trim mean quarterly, that means trim mean CPI on a quarterly basis. Q3 means core CPI also kind of decelerate as well to 3.5% in Q3 versus 4% that was printed in the previous quarter of Q2. All right, so these are the data point I'll share with you. And also one more interesting data point that I'll share is there's this news flow leak by Reuters pertaining to this upcoming fiscal stimulus that market is actually expecting the MPC, which is the kind of a parliament body in China, to announce after the the so-called their annual meeting that's to be actually held from 4th of November to 8th of November. So there's this Reuters news that was released yesterday. What they quote over here is based on sources over here. So sources inform Reuters saying that, let me put it next, okay, give me, I think it's hang. All right, let me expand it. All right, saying that 6 trillion yuan together with 4 trillion bonds. So additional 10 trillion yuan is likely to be announced, all right, on the 8th of November. Okay, so because this annual meeting is by the National People's Congress, MPC. So this MPC is kind of a rubber stamping body to approve new policy officially, and they will hold their meeting to be held from 4th of November to 8th. So very likely the official numbers will be on the 8th of November, coinciding in line with the week of the outcome of the US presidential election. And the source or even told Reuters that top policymakers may announce stronger fiscal package if Trump wins the November election. Why? Because we know that Trump has already proposed tougher or higher tariff towards China products coming into the US. There's additional 60% tariffs. So to counter that, we need to have a higher fiscal stimulus package to actually counter this higher tariffs proposed by Trump, if Trump were to actually hold on to his proposal. All right. So but however, market initially pop up in the futures market. That means once this was announced quite late in the Asia session, so we see the Hang Seng Index actually gap up over here after the news flow, because after this news flow was released. But however, thereafter the market didn't actually react quite positively to this news flow and starts to dwindle down again. So market participants seems to ask that they want to actually hear the real number first before putting in any we call it fresh long position on the China stock market, or even as well as the proxy as well. So very likely it may start to trade sideways again going forward, ahead of the inline, ahead of 5th of November and as well as 8th of November, which is the last day of the MPC meeting. And on 8th of November, very likely the official numbers will get announced in terms of fiscal stimulus. All right. So that is the key data and news flow that I will share with you, and their impact on the broad-based cross asset classes. All right, that I'll share. Okay, so right now let us talk about more about the US presidential insights. So US presidential insight market participants in the financial market is very fascinated about this betting odds market, which is from poly market, which tends to be has a lesser error compared to other betting markets, and is much more liquid. And based on this poly market live betting market, Trump has been leading comfortably. So right now he inches up by another 0.3% point, whereas Harris dropped by 0.4 percentage point. So Trump is leading comfortably at 66.5%, and Harris is at 33.5%. So what we could see over here is that the betting markets, the current most liquid betting market is poly market, and financial market traders are looking at this market to judge the performance of that Trump trade. Okay, so what is trump trade? So trump trade is basically for a broad-based cross-asset perspective, will be push up in the US 10-year Treasury yield, leading to a stronger, firmer dollar that was seen in 2 weeks and 2.5 weeks or 3 weeks ago, where the betting odds has started to skew above 60% in favor of Trump. And with that, we also start to see gold prices inching up higher as well. Why? Because Trump proposal will lead to a higher budget deficit in US, and higher budget deficit in US, there's a risk of what I call more government shutdown that would potentially lead to what I call higher risk of credit warning in US Treasury debt, and that could actually potentially favor gold as well. So that's why gold is actually moving in line with Trump betting odds. All right. So, but however, if we were to look at these betting odds versus polling odds, all right. So polling odds is survey. That means there's no money at stake. So if you look at the polling survey based on Real Clear Politics. So Real Clear Politics is the one that's more comprehensive because you get the average of polling sources. So polling sources can be done by popular news outlet like Wall Street Journal, CNBC. So they get a slew of average of them. So based on the latest data, okay, this is not live because you know that it's not, there's no money at stake at all. That means there's no betting, just based on survey data, and survey is not done every day or so. Right. So this market as of, let me see, where's the latest one? Okay, yesterday 29th of October 1. So Trump is only leading comfortably by 0.4%. So if you look at the average, right, it's almost neck to neck. The polling average 48.4 Trump, 48 Harris. So now the big question we've got to ask ourselves over here is that what if the poly market betting odds is too optimistic, that's skewed towards Trump? And on the real outcome itself, that means these are stressed again yesterday, the real outcome on 5th of November is going to be very similar to the polling markets. That means it's too early to call for a clear victory. That means there could be a potentially delay in terms of waiting for the final votes to actually come in. So it could take about 1 to 2 days later for mailing, because it's the US, there's different ways to actually count the votes. All right, one is by electronic, one is by mailing odds over here, and we call it ballot mailing. All right, so if that were to scenario were to take shape, that means the betting market is wrong to actually favor Trump to have a very high odds of a victory, and instead the polling market has a better picture, but market is ignoring the polling market right now and skewed towards the betting market. So that could potentially see a snap reversal of the Trump trade. That means potentially we could see a setback in gold strength coming forward on the 5th of November, on the 6th of November Singapore time, because we are a day later, and also a dollar strength setback scenario reversal could take shape as well. All right, so this is something I want to share with you all in terms of the US presidential insights. And in fact, right now, intermarket analysis, so I will join it together with the intermarket analysis. So in fact, right now, the 10-year US Treasury yield, yes, it has been pushed up in the last 2 or 3 weeks or so, in line with this Trump trade that is taking shape because of Trump is leading over Harris by a wider margin based on the poly market betting odds. The 10-year US Treasury yield right now, okay, where is it? Yeah, over here. It's now right exactly at a key major resistance at 4.4%. So we know that this steep rise since the start of October, that means 3 to 4 weeks ago, push up, clear above the 200-day moving average. And right now, what we see over here is that it's hovering right below the 4.4%. And yesterday, it formed a bearish shooting star. A bearish shooting star hitting the high of 4.33%, just 7 basis points below the 4.44% major resistance. Why this is a major resistance is in fact derived by a major descending trend line that prevent the US Treasury yield from breaking out since the high of 23rd of October last year. So that's close to about a year ago price action. So it's considered as a major resistance level, not a minor one, because it takes a year to actually form also. So with this bearish shooting star candlestick that's being formed over here on the 10-year US Treasury yield, and as well as this bearish divergence that's being seen on the RSI that's really hit the overbought region this week. So there is actually right now high risk as we head into the US presidential election polling day, 5th of November, US time, 6th of November, Singapore time. And if the actual results doesn't come in line with the betting markets that is skewing towards a very high chance of a Trump victory, there could be a setback in the US 10-year Treasury yield, or in fact, from today until 6th of November, it may start to really consolidate. All right, consolidate first. And if the actual result on polling day didn't come in line with the betting market's expectation, we could see a much more deeper reversal on the 10-year US Treasury yield back towards this support level over here, which is close to the 50-day moving average at 3.9. All right, so right now it may just consolidate first, holding above the 20-day and the 200-day moving average at the 4.15% level. All right, so in a nutshell, what I want to stress you over here is that given this bearish candlestick and as well as the bearish divergence that's been seen or displayed right now on the 10-year US Treasury yield, the last 3 to 4 weeks of dollar strength in some of the major FX pair, especially the dollar, because the euro dollar, because the euro dollar has a high weightage in the US dollar index, that could actually see slowdown in dollar strength going forward. All right, this is what I'm trying to stress in terms of the intermarket dynamics, in line with the expectation that is being placed on the betting markets on the expectation of Trump winning the US presidential race, but that actually has a huge divergence with the average polling market statistics. All right, so if you were to look at the 10-year US Treasury yield in line with the US dollar index that is moving in the direct correlation as well, what we could see, the dollar index also shaped this shooting star, but this shooting star over here is we call it a gravestone doji. Okay, the body is much thinner, but you have a long candlestick as well. Also coming very close, not very exactly close, but rather a distance away from the major resistance level at 1.10550, 10637. All right, over here, which is this major descending major range symmetrical triangle range upper boundary that is in place since 4th of October last year. Okay, so overall the US dollar index seems to be trading inside this range after hitting the low of 19th of July 2023, push up, came down, push up, came down. So it seems to be that at this major symmetrical triangle range and price action, yes, it still has a bit way more to go to hit this major range resistance of the upper limit of this major symmetrical triangle range configuration that is in place since 3rd of October last year. But given this bearish gravestone doji candlestick on a daily basis on the dollar index, and if you look at the RSI of the dollar index, also starts to there's no bearish divergence, but it starts to actually exit from the overbought region. Okay, exit from the overbought region. So what it means that there could be also some form of setback coming into play as well. All right, at least on a 1 to 2 days basis, holding above the 200-day moving average at 103.76 level. So like I say, if the expectation of the Trump trade starts to reverse on the actual day, that means the actual day results on 6th of November Singapore time doesn't go in line with the high odds of the betting markets, poly market that is stating Trump to win, then potentially the Trump trade may do that reversal due to what I call short, unwinding of this Trump trade high expectation, where the US dollar index could actually shape that mean reversion decline to revisit the 102, this level here, let me 102.35, 101.78 support region, which is also confluencing with the 50-day moving average as well. Okay, so something to take note of. All right, so yeah, this is the US presidential insights I'm sharing with you all in line with intermarket dynamics, okay, based on the US 10-year Treasury yield, the price action, and its direct correlation right now with the US dollar index, which could also potentially influence the euro dollar, because the euro dollar has a high weightage in the US dollar index, and we know that the euro dollar trade also very closely with the sterling dollar. All right. Now, with that, let us now comes to the intraday technical outlook on the various broad-based cross-asset classes. So with that, let me expand my screen so that you guys could actually have a better view on the chart. Okay, so let me start with the FX market first. All right, so before we jump straight into the individual major dollar FX pair, let's have a quick look as what has taken shape in terms of the performance of the dollar against the other broad-based currency. So what you see over here is this the 5-day rolling performance as we are speaking right now. The dollar is still very strong against the Aussie. Why? Because of the weakness on the inflation data that was that I shared with you earlier, and that also managed to actually drag the Kiwi dollar as well, and the dollar yen continues to trade firmly as well due to this political influence, internal political influence that is taking shape in Japan. So I do not want to talk more about details about the later Japan snap election and the impact on the Nikkei and the dollar yen that has already been covered much ground in the last 2 days of daily dose. So for those who wants to listen, my take on that can look at our YouTube channel, the OANDA Asia Pacific YouTube channel, and have a listen in the previous 2 days of daily dose. Right, we have covered much ground, and the rest of the other currencies start to more or less trade sideways. And in fact, the dollar underperformed against the euro and the sterling. Why? Because the 5-day performance of the dollar against euro, the dollar against sterling is trading below the US dollar index. Right. So this is what you see over here. So still a kind of outlier performance right now in terms of the individual FX pair. Right. That means we don't see a very clear direct sign of dollar strength across the board. So very clear dollar strength is only being seen in the Aussie, the Kiwi, some from the CAD, and against the Japanese yen. Okay, now with that, let us now jump straight into the individual technical outlook, starting with the euro dollar first. Still bear in mind that the euro dollar yesterday, we have a bearish bias. It came down as expected, almost hit the 1.0750 medium-term pivotal support that we have. So that was our so-called initial level to watch for our bearish bias, and price action managed to reverse up slightly above 1.0750. And on the daily time frame chart, what it share with you all is that it shaped this bullish dragonfly doji yesterday after the test of very close to this 1.0750 medium-term pivotal support level. So why this dragonfly doji is very important? It formed right exactly after testing the lower limit of this major symmetrical triangle lower limit, which is the trend line support level that I drew from the low of 3rd of October. And as well as the RSI has started to shape that bullish divergence as well. There's a very clear bullish divergence, and yesterday it showed a higher low. All right, so net overall, what it means that the bearish momentum since 25th of September all the way down to the low of 23rd of October, close to about 4 weeks of bearish momentum, has starts to ease off. So given this bearish momentum easing off, there could be a sign that at least some form of mean reversion rebound that could take shape on the euro dollar, at least on the short term to intraday basis. So with this appearance of the bullish dragonfly doji, pardon me, that's right exactly at the lower limit of the major symmetrical triangle range support level, or the major symmetrical triangle range support, and slightly above the 1.0750 medium-term pivotal support with positive showing on the daily RSI. I cannot be outright bearish today right now because it doesn't just justify for me given a higher technical element that is flashing much more positive sign than negative sign. So with that, I will flip to a intraday bullish bias on the euro dollar, like I explained earlier on, still using 1.0750 as my pivotal support for today, which is the medium-term pivotal support. First resistance level to watch out for will be at 1.0840. That means there could be any chance of a minor pullback. But however, as long as minor pullback didn't surpass below 1.0750, I cannot put it so tight because that is the level that I define on the daily time frame. Okay, so perhaps the first support level to watch out for will be yesterday's minor low, right, at 1.077. All all right, over here. So first resistance to watch will be 1.0840. Above it sees the mean reversion rebound gaining traction to revisit 1.0870 slash 1.090, which correspond to the 200-day and the 20-day moving average, acting as a similar resistance zone as well. Only a breakdown below 1.0750 will invalidate today's intraday bullish bias to see the continuation of that 4-week of corrective decline in the euro dollar to expose the next near-term support level at 1.0710 followed by 1.0670. All right, no change on that level. Okay, so now with that with the, we call it a bullish element that is being depicted on the euro dollar. Like I mentioned, the euro dollar do have a close relationship or correlation with the sterling dollar. I also cannot be outright bearish on the sterling dollar, despite the fact that it didn't clear above our pivotal resistance at 1.3015 yesterday. So with this, I will turn neutral on the sterling dollar for today, neutral between 130.15 and 129.50. All right, on the sterling dollar. Only an hourly close above 130.15 will validate a mean reversion rebound scenario on the sterling dollar for it to see the next near-term resistance to come in at 130.60 followed by 131.07. Okay, now with that, let us turn our attention to the Asia Pacific dollar pair, starting with the dollar yen. So no change on the dollar yen, still looking to maintain that bullish bias, slightly tidy up the short-term pivotal support level from 1.24 15230 to 15240, taking into account of the minor swing low of Monday. So price action continues to print a series of higher low, and the RSI also continues to hold above this parallel ascending trendline support as well. So as long as 15240 short-term pivotal support holds, still looking for a bullish bias on the dollar yen. So first resistance to watch for sure will be at 15380. Yesterday it was tested again during the start of the US session before shaping that pullback. So above 15380 potentially sees the next resistance coming in at 15470 slash 15480. So this level is pretty key. Why? Because if you look at the daily chart over here, this 15470 level previously induced the last round of steep sell-off, okay, after the test of it on 30th of July. All right, 30th of July it tests, then thereafter you see a consecutive day of steep sell-off. So this is a rather critical level to watch out for, 15470 slash 15480. Okay, however, if price action starts to break down with hourly close below 15240, today's intraday bullish bias will be invalidated to kickstart a, at least in first step, a minor corrective pullback scenario unfolding on the dollar yen, seeking out the next near-term support level at 15155. 15155, which is the 200-day moving average, and as well as the minor swing low of 25th of October. Over here, a breakdown below it extend the mean reversion decline towards 150.30, which correspond to the rising 20-day moving average. So that's for the dollar yen. So still maintaining that intraday bullish bias. Now, Aussie dollar. So like I mentioned, Aussie dollar has been weak due to the fact of that very lackluster inflation data that's coming out. So price action has really started to shape lower low, and with that, I will have a tighten key short-term pivotal support for today. Pivotal resistance, pardon me, a bit tongue twisting. Tighten pivotal resistance at 65.86 over here. Okay, let me put it in writing. 65.86. Okay, 65.86. Okay, this will be the normal resistance. Okay, remove this. 0.6660. Okay, so have a tighten key short-term pivotal resistance at 66.86. Next support level to watch out for will be 65.20 slash 65.10. This level is the 2 times Fibo extension level over here, and however if 65.10 gives way, the next support area to look out for will be this level, the minor swing low area of 6th of August. Okay, which is at 64.75. All right, 64.75 next. which is correspond to 6460 as well. The next Fibo extension 2.618 and 1.236. So it's a zone 0.6475 slash 6460. Okay, so I repeat again, still maintain that intraday bearish bias on the Aussie dollar using a tighten key short-term pivotal resistance now at 66.86. Next near-term support level to watch 65.20, 65.10, followed by 64.75, 64.60. Only an hourly close above 66.86 will jeopardize today's intraday bearish bias to potentially kickstart a mean reversion rebound scenario. In first step, 66.15, above it exposes 66.60 next. So that's for the Aussie dollar. So that also sum up the intraday technical outlook on the broad-based dollar pair against the other major currency. So with that, right now, let me share with you one particular FX cross pair, which is the Aussie Euro Aussie, also taking into advantage of the Aussie weakness as well. So yesterday, okay, whoops, what is it? Okay, so this Euro Aussie previously, as I was preparing, right, it already hit the first resistance level right now at 65.50. So with that, I will have a tighten key short-term pivotal support now on the Euro Aussie, which is taking into account of this level here, which is the minor ascending channel support level at 64 is 64.70. All right, 64.70. Okay, 64.70 over here. Okay, then this will be a normal support level. Okay. Okay, so right now, tighten the pivotal support on this particular FX cross pair, Euro Aussie at 1.6470, above 65.50, sees the next near-term resistance coming in at 66.20, 1.6620, which is the minor swing high area of 6th of September and 12th of September. Only an hourly close below 64.70 will invalidate this intraday bullish bias on this cross pair, Euro Aussie, to see a kind of a corrective pullback scenario unfolding again on the Euro Aussie to expose 1.6420. Below it sees 63.40 next, which is corresponding with the 50-day moving average as well as this dotted bullish breakout line pullback support level as well. So something to take note of for interesting we call it technical configuration on this Euro Aussie FX cross pair, that we have a bullish bias holding above 1.6470 short-term pivotal support level. So that's for the FX market. So with that, let us now turn our attention to the major stock indices, starting with the Hang Seng Hong Kong 33. So this is what I mean. Failure to actually have a proper breakout after the announcement yesterday, and right now it's tumbled all the way down to test our short-term pivotal support that we have yesterday at 20,255. So we will flip to a neutrality stance for today on the Hong Kong 33, neutral between 20,255 and 21,055. With an hourly close below 20,255, then we will see a revisit of the medium-term pivotal support zone at 19,790 slash 19,445, which also correspond to the rising 50-day moving average as well. All right, so that's for the Hong Kong 33. Flip to a neutrality stance for today, neutral between yesterday's high at 21,055 and 20,255. Now, turning our attention will be the Japan 225. So the Japan 225 continues to rally as expected and hit the resistance level at 32,230 level. All right, so with that, the RSI still holding above this parallel ascending trendline support above the 50 level mark, indicating that upside momentum still remains intact. So potentially there may be some signs of a pullback taking shape over here. So the pullback could come in place with this level here. Okay, at around 39,170. So using a tighten key short-term pivotal support for today at 38,910. So as long as this minor pullback didn't surpass below 38,910, we'll still maintain that intraday bullish bias on the Japan 225. First resistance level to watch 39,550 slash 39,680. Above it potentially sees the swing high of 15th of October, which confluence with 40,155 slash 40,280. Only an hourly close below 38,910, then that would invalidate today's intraday bullish bias to see a steeper pullback scenario unfolding on the Japan 225. seeking out the next near-term resistance, near-term support level, pardon me, on the downside, 38,706. A breakdown below it sees 38,315. Revisit the previous congestion area of 24th of October and 28th of October, also corresponding very closely to this upward sloping 50-day moving average as well. So that's for the Japan 225. Now, turning our attention will be the German 30. Still recall that the German 30 we were neutral yesterday, so it broke above the neutrality range, almost hit the resistance level. Then thereafter, reintegrate back into the upper limit of the neutrality range again. So this is something like a failure bullish breakout, and the hourly RSI very clearly broke below the parallel ascending trendline support. So with that, we can now have a very clearer picture on the German 30, indicating that there is no clear signs of a positive follow through yesterday after breaking above our neutrality range and almost hit the resistance level. So with that, I'll be using this level as my first resistance level to watch out for, 19,560. Pivotal resistance will be at 19,690 / 19,755, and we will flip to a intraday bearish bias for today, given this bearish element that has been depicted as explained earlier on the German 30, failure bullish breakout with a breakdown of the parallel ascending trendline support on the hourly RSI. So flip to a bearish bias for today on the German 30. First support level to watch out for will be the 20-day moving average that is converging with the near-term support zone graphically at 19,370 / 19,320. A breakdown below 19,320 exposes the next near-term support at 19,130. However, if price action starts to reintegrate back above the 19,560 level, then and a breakout above 19,755, that would invalidate today's intraday bearish bias on the German 30 to seek out a much more pronounced rally of an impulsive up move to test the next resistance level at 19,930, which is the 0.764 Fibo extension taken from the low of 11th of September. Okay, so that's for the German 30. Now, turning our attention will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 continues to print a series of not higher highs, similar high below the 20-day moving average. But however, the RSI continues to print a series of lower high, what we could see over here. So indicating the lack of upside momentum. So still no change, 42,720 short-term pivotal resistance on the US Wall Street 30, still maintaining that intraday bearish bias. First support level to watch will be at this 42,005 level. Okay, 42,005 level. A breakdown below it exposes 41,885, which correspond to the rising 50-day moving average, as well as very close to the lower boundary of this medium-term ascending channel that is in place since the start of August, 5th of August to be precise. Only an hourly close above 42,720 will invalidate today's intraday bearish bias to kickstart a impulsive up move, at least to seek out the next near-term resistance level on the intraday basis at 40,060. Above it potentially sees 43,540 next. Okay, so what's next for the Nasdaq 100? So the Nasdaq 100 yesterday, yes, it did a bit of, it pierced above the 20,615 level. So yesterday we do have this short-term pivotal resistance here at this level here. Okay, give a minute now. Okay, this was our short-term pivotal resistance day, 20,615. Okay, so it pierced above this level, and right now it seems to be reintegrating back into this level again. All right, so what we could see over here is that price action did has a positive follow through. Okay, no clear follow. I mean, the candlestick is not that great. Then thereafter, now during the Asia session, it starts to appears to reintegrate back below the 20,615. So yesterday's this residual push up over here could be also due to this failure bullish breakout, due to this optimism that's being placed on the mega cap technology stocks, all right, over here. So with that lack of upside momentum follow through that we are seeing right now on the price action of the Nasdaq 100, I do not have a very strong conviction that price action could continue to go up at this juncture. So with that, I will flip to a neutrality stance on this Nasdaq 100 for now, at least on an intraday basis, and we see how the price action developed in today's US session. So neutral between the upper limit is the current all-time high at 20,790. So this being derived on our CFD index, 20,790, and also this former minor swing high now turns into a pullback support slightly below the 20,615 level at 20,560. So if we start to see an hourly close below 20,560, for sure there's a high chance that yesterday is a failure bullish breakout, and potentially price action could reintegrate back below 20,310, and potentially that is coming very close to the 20-day moving average and even 20,155 next. All right, so that's for the technical outlook on the Nasdaq 100. No conviction of this breakthrough, given the current price action that is depicting right now is kind of lackluster. So there's a risk of a failure bullish breakout on the Nasdaq 100. So neutral between 20,790 and 20,560 first on the Nasdaq 100 for today. So that sum up the intraday technical outlook on the broad-based stock indices. So now turning our attention will be the commodities market, starting with gold XAU/USD. So gold XAU/USD continues to trade in a bullish uptrend, at least on a short-term intraday basis, ahead of the 6th of November or 5th of November polling day. So the result will come in on 6th of November Singapore time, US presidential election polling. So far, the momentum has been strong. No clear signs of exhaustion. Why? Because the RSI doesn't shape any bearish divergence. It continues to trade higher high. Yes, it's in the overbought region already. It hit the first resistance level at 2,774/2,782. So with that, there could be a chance of a minor pullback taking shape. So first pullback support level to watch will be this minor swing high area here of 23rd of October and 29th October, now acting as a minor pullback support, pardon me, at 2,760. So as long as I have a tightened short-term pivotal support slightly below it at 2,747. So as long as this minor pullback then surpass below 2,747, we will still maintain the intraday bullish bias on gold XAU/USD. Next near-term resistance level to watch after this minor pullback taking shape will be the psychological level at 2,080, which is correspond to the Fibo extension clustering level. And above 2,800 sees the next Fibo clustering level coming in at 2,826. Only an hourly close and a drop and a breakdown below tightened short-term pivotal support for today at 2,747 will invalidate today's outright bullish bias to kickstart a much more deeper corrective decline scenario. That means, i.e., a mean reversion decline scenario to revisit 2,728/2,715 support level. A break below 2,715 sees the next near-term support level coming in at 2,684, which correspond to the rising 20-day moving average as well. All right, so that's for gold XAU/USD, still maintaining that intraday bullish bias for any potential minor pullback. So there could be a minor pullback taking shape first, with the key tighten short-term pivotal support at 2,747 for today. So that's for gold. Now, turning our attention will be the next commodity market will be oil, West Texas crude oil. Let me open up the chart of oil over here. Okay, West Texas crude oil. Okay, give it a couple of seconds for it to run. Right, so still no change. Still, yesterday West Texas crude oil came down, almost hit the short-term support level at 67.55/67.10 before staging a rebound at this juncture. So given that there is this bullish divergence that has started to take shape on West Texas crude oil. So with that, I will have a neutrality stance for today. Okay, given this bullish divergence. Okay. Okay, so I will turn neutral between 69.50 and 67.55/10. All right. However, if price action starts to have an hourly close above 69.50, then potentially we could see another round of mean reversion rebound taking shape to do some partial retracement of this close to about 4 weeks of decline on this West Texas crude oil, taken from the high of 8th of October all the way up to yesterday's low. So the next resistance level to watch out in this partial retracement, or as we call it, a mean reversion rebound snapback rally. 70.55 above 70.55 may see 73.50 next, which correspond to the 50% Fibo retracement. Right. So due to this bullish divergence that is being seen on the hourly RSI, my bearish bias has been reduced in terms of conviction. So flip to a neutrality stance on the intraday basis on the West Texas Oil, neutral between 69.50 and 67.55/67.10. Right. So that sum up the intraday technical outlook on the broad-based cross asset classes as well. So before we go, let's take a look at the economic calendar. What are the data to look out for today? Okay, so in terms of economic calendar, today we Wednesday. So today, important data will be centered more on the Eurozone. Why? Because we have the flash Q3 GDP data out from Eurozone out at 6 p.m. Singapore time. And as well, going to the US, we also have a GDP growth rate as well for Q3, the flash one, out at 8:30 p.m. Singapore time for today. And after that, at this inflation rate for Germany, that's out at 9 p.m. Singapore time, which is a flash data as well for the month of October. And pertaining to more of an intraday basis on oil, the WTI crude oil market will be the weekly EIA crude oil stockpile change report that is out at 10:30 p.m. Singapore time. And also bear in mind that tomorrow itself, there will be no key data to look out for, but stretching into the US, the early morning session will be the MPS manufacturing PMI data and the non-manufacturing PMI data for China out at 9:30 a.m. Singapore time, followed by 11 a.m. with the Bank of Japan interest rate decision, followed by the quarterly outlook report. All right, so very unlikely Bank of Japan will do any changes to its interest rate decision, but market will tend to see whether will they change their tonality in their gradual interest rate hike cycle, given the current political uncertainty surrounding in the Japanese political arena. So something to look out for during the monetary policy statement, and as well as at somewhere around 2 p.m. or 1 p.m. Singapore time, the BOJ governor, so-called the BOJ governor press conference. And into the earnings calendar for today, after the close of today's US session, okay, so we go all the way down. Okay, where is it? Okay, Wednesday, all the way down over here will be the release of Microsoft and Meta. So that will take shape at after the close of US session today, early tomorrow morning around after 4 a.m. Singapore time. All right, over here. So with that, tomorrow is a public holiday, so there will be no daily dose. So daily dose will resume again on Friday, which is 1st of November. So with that, do have a short break for tomorrow. And for those who celebrate Deepavali, happy Deepavali. And this is Kelvin here signing off, and we shall speak again on Friday. Thank you.